And over time, you can look at it, they converge, they diverge, they converge, they converge. There's never been a divergence this big, not even close.
What's going to happen that brings these two things together, essentially? Like, do you just not know, or do you have an inkling as to what will actually bring these two things together?
They are going to sell them at a price where they're going to have to lower the NAV. You can't cheat the NAV on a sales price. The cash is the cash, right? But the NAV comes down, it's going to spook investors who are going to make more redemption requests. They're going to have to sell more properties, and on and on. And you get into this death spiral type scenario. We have had FINRA tell us outright that we can't bring up this fund and the other. I mean, the whole point of what we're doing and exposing this thing was to show people, to help people that what they're in now is drastically overvalued. Here are the risks.
Hey guys, it's me, 𝗪𝗙𝗪𝗧𝗧, and today I'm going to be speaking with Phil Back, an ex-director at the New York Stock Exchange. I reached out to Phil after I read his post titled The Big Bad REIT Post. In this post, Phil, a REIT and capital market specialist, noticed that a couple of funds were performing well, extremely well. This led Phil to try and uncover what is so good about these funds so that he can apply it to his own ETFs and make it available to even more people. However, as he was doing his research, he discovered that what these banks were doing was potentially not clever at all. But before we get into all of that, I wanted to talk to Phil about his experience in the New York Stock Exchange, his 16 years in finance, how finance has changed since 2008 and over the years, what are the biggest challenges and biggest innovations. If you want more of Phil on this channel, then please leave a thumbs up and subscribe. And also, if you have any questions for Phil and I do another interview with him, make sure you leave them in the comment section below. And if you want to read Phil's Substack article, that will also be linked in the description. Okay guys, enough setup. Let's get into the episode. I really enjoyed filming this one, so please, if you enjoyed it, leave a like and subscribe. On with the episode.
My name is Phil Back. I've been doing capital markets and product development in the fund space for quite a while now, for about 16 years. Mostly alternatives and ETFs. Spent several years at the New York Stock Exchange working on ETF listings, rules, regulations, working with market makers, regulators, ETF sponsors. Started a company in 2017 called Exponential ETFs. We were known for, we had a couple funds. We're probably best known for one that used customer satisfaction as a leading indicator to pick stocks, and another one that was the inverse market caps. We weighted the S&P by smallest to largest. But we were better known for building a sub-advisor business where we managed capital markets and portfolios on behalf of other ETF issuers. We sold that company to Tidal Financial Group in about 2022. And since then, I've been working on the real estate asset class and a number of aspects of it. Mostly the thing that really keeps me up at night and that we're really obsessed with is the divergence between public and private real estate in terms of not only prices, but even valuation metrics, factors that people look at, and just the whole, how the whole investing, landscape has evolved differently in these two areas just by the structure of the funds. We've been working on that and working on solving that, and that's what we're doing with Armada ETFs.
So we are going to be getting round to ETFs, and basically you've seemed to have noticed something in the way that major banks are pricing their ETFs for housing. Is that right? And just feel free to jump in if I'm saying anything wrong. So before we get into that, I want to get into more. You seem to have had a really interesting career, and a lot of my audience have never been exposed to the institutions at capital markets. So one thing that I'm just curious about, the second I learned that you used to work for the New York Stock Exchange, I just wanted to talk about that a little bit before getting into those other things. How has finance changed over the last 16 years that you've been working in it?
For my time at the New York Stock Exchange, followed the global financial crisis, and ETFs were for a long time, I don't know if they still are, but for a long time they were considered like the Silicon Valley of finance. All the big new ideas, all the cool innovations, everything was happening in the ETF space. And ETFs are governed just like mutual funds in the US at least, by the SEC, by the Division of Investment Management. But on the exchange side, you've got this whole other world of the Division of Trading and Markets at S&P, which also governs ETFs. Famously, when the Bitcoin ETF was held up for almost 10 years, it was the Division of Trading and Markets, and their filing, which is called the 19B4 filing, is actually driven by the exchange, not the issuer, is where they've held up innovation. And for most of my time there, following the global financial crisis, financial innovation was considered a bad thing. They were trying to literally, as a public policy, trying to stifle innovation, and they looked very skeptically and cynically upon anything that had anything to do with, financial.
What do you think it was about ETFs in particular, maybe, or just finance innovation in general, that worried institutions so much?
It was the pace of innovation. There was the pace of innovation and the idea, I think some of the regulators, we don't know what we don't know. They had these leverage ETFs, which became very popular, and they were being blamed for all sorts of, market movements and day movements, all sorts of things, which, ultimately they were not responsible for. The Kauffman Foundation came out with this huge report talking about how ETFs were, going to cause all sorts of systemic problems. That's been massively debunked. But a lot of that came from, the traditional active managers who for a long time had, the place to themselves. They were charging high fees. They were underperforming. They didn't want ETFs. ETFs now, you've got active ETFs, you've got systematic alpha-seeking ETFs, you have all kinds of funds. But early on, ETFs were synonymous with passive market cap weighted broad benchmarks or index funds. And they were growing in popularity, and they were cheap, and they were a threat to a lot of the business. So a lot of it came from inside the industry, and a lot of it came from the regulatory side, which after the global financial crisis just, took on the view that innovation in the context of finance is bad. There's no good innovation. It's all bad. Let's slow it all down. We don't want this.
What's the intrinsic difference between, say, an index fund like the S&P 500 tracker and an ETF? What's the definable difference?
There's very little difference. If you take a regular passive index fund, right? So let's say you do the Russell 2000. The way the fund is managed on a rebalance from day one to day two, when you rebalance the fund and the fund holders is the same exact process as a discretionary active ETF that's transparent. There's a couple that are not transparent. We don't need to go down that rabbit hole. But for the vast majority, it's the same thing. You just, you post up on a T1 line, you post up the new holdings, the market makers price accordingly, and you're buying and selling based on, where the market makers are around the fair value. So there's really very little difference. What's important is understanding, the methodology. There are a lot of passive index funds that have active discretion. The S&P 500 famously has an index committee. They were very late to adding Tesla, for example, to the S&P 500.
And why was that? Just because its valuation seemed absurd? It seemed hype, or?
Pretty much. Yeah, that's right.
Yeah.
So there are index funds that act like active funds. There are active funds that act like index funds. And I think the line between the two is becoming very quickly blurred.
And so ETFs and index funds, they are fairly similar in nature.
ETF and index mutual funds are very similar in the end result to the client. Index funds are, you could say, a brand of ETFs. I mean, the ETF is a wrapper, right? So the ETF does it trade on the secondary market? How is it priced? Is there a bid-ask spread, or is there a NAV set by the fund manager? Index fund just means it tracks the fund methodology, tracks an index. And it used to be that index meant, the broad benchmarks, right? The famous, your EFA, your the S&P, your index now can be a rule set that's 6 or 7 pages long that tells you, very detailed which factors it uses and how the weighting is. And the weighting, the importance of the factors changes based on, market regimes and different things. The indexes can become very complex now. So, the word index really, what it really means is rules-based or systematic.
And it's funny, just hearing from you describing about it, you don't often think, I think a lot of investors don't really understand why so many rules exist in finance sometimes. And it's like, well, the price of Apple can change 1 million times in a day. And so how do you change the weight? How often do you change the weighting in index fund based on all of these changes and stuff like that? You've got to have, I guess, 6 to 7 pages of rules for what is arguably something that is very, very simple.
Yeah, well, a simple. If I said, hey, we're going to do the S&P, the 500 largest stocks by market cap every quarter, we're going to rebalance on a quarterly basis in a scenario of a corporate action, if a company delists or a new company IPOs, here's how we're going to handle it. Those aren't the 7-page, page methodologies. It's, let's say you're going to do a multi-factor. I mean, there's all sorts of stuff you can do. The big divide here, right? The big thing that you want to look for is whether or not you want manager discretion, whether or not you think that's a good thing or a bad thing. There's a lot of people say, I want to know that I've got somebody with good judgment who's sitting on top of this thing that can override the models. And there are other people that say, I want to be a pure Vulcan, right? I don't want any manager who can be a cowboy, who can panic. I want every scenario laid out ahead of time in a rule set and manage a fund like an algorithm, right? Ice cold, pure rules. And that's really the difference here.
Got ya. It's interesting. So, like, thinking of ETFs as an innovation that was being updated and coming out at the same time as an iPhone, but it's not. For me, I started investing when I was 19, and that would have been while you were working at the New York Stock Exchange, and sort of seeing these ETF and innovations. So for me, an ETF is something that's always been around. From the point at which but at the beginning, I wasn't actually playing around with ETFs, and now I'm starting to see them crop up more and more. And I'm trying to, as an investor, try and understand the benefits between an ETF and an index fund and various tax benefits and discounts on fees and stuff like that. Is that what you would say is the biggest innovation in finance over the last, say, 10 years? Is ETFs coming out?
I would say that the ETF has allowed other innovations to continue. The ETF itself is slightly innovative. The difference between an ETF and an index fund, you're looking into it, slightly different on taxes. You might pay a little bit more. The embedded capital gains within the ETF will be better, but you might have to pay a transaction fee or sometimes a hidden transaction fee in the form of a bid-ask spread for the ETF. They're slightly different. I think net, those differences favor the ETF more often than not in every scenario, but mostly it does. And that's why the market is kind of migrating slowly, choosing the ETF. But the ETF, the innovations are slight. It's what you can do within the ETF. And the idea that any asset manager who's got a better idea can come to market without any gatekeepers, without any minimums. They can launch a fund. It's not cheap or easy to launch these funds, but it's not impossible, right? It's a lot easier than getting, let's say, a hedge fund off the ground. So the fact that you can go and bring these products to market allows you to innovate in a number of ways. Those efficiencies that allowed the ETF to be the vehicle that asset managers or would-be asset managers can express their views and bring them to the public with, that is starting to diminish. Unfortunately, it's going the other way, right? It's going where now it's harder and harder to get a new ETF off the ground. It's harder and harder to get access to financial advisors and certain channels as an asset manager. Those are getting walled off. They're getting bought off in many cases.
Is that the same fear as before?
Yeah. Everything that's new and innovative eventually becomes institutionalized and corrupted, right? And that's what's happening. And what we are seeing now, what we're seeing all the innovation, obviously, is on the crypto side. And that doesn't mean Bitcoin number go up or anything like that, but it does mean that there are a lot of smart people building a lot of very cool things in that ecosystem. And if you're not paying attention to it, you're going to miss the next thing. So it's interesting to see how these things cycle.
Is there a country that you think is innovating finance well?
Close to here, Canada has been consistently ahead of the US in terms of innovations, in terms of what they're doing, use of derivatives within their funds. They've done a lot of very cool stuff has come out of Canada before the US. I think the regulatory environment is slightly friendlier to innovation there than here, although that's changing. It's changing now here. It's becoming a little more easier to do good things.
Yeah. Similar over here, it seems in the UK we're quite we're quite welcoming to things like crypto and regulating them and having a bit more clarity over what people are allowed to do, because I think that's sometimes the bigger issue is America. It seems to be like you're unsure on what people are allowed to do, so people want to play within the rules, but there's not a real rule book and they just come around randomly and crack the whip at different people.
Absolutely wild. There's an organization here called FINRA that governs us, it governs asset managers. They don't have written rules. It's all based on precedents. You have to ask around. It's not a great framework for innovators to play in when there's so much regulatory uncertainty.
And does the interest rate environment change this as well? Now that we're going up to, we're probably potentially going to be stuck at 5% interest rates for quite a long time, or around this level.
Yeah, yes and no. It's when rates were so low, it was probably easier at large scale to finance, private equity type deals. And, there's probably more VC money floating around. But that's not going to be the difference maker. If you can't get funding and you're blaming the interest rate on it, I'd say look forward.
A lot of funds were sold on, a lot of people don't really know what they're buying when they invest in things, but on the premise that you can get 5% returns and stuff like that. And now once you get 5% returns from a government bond. And this is sort of, I'm slightly sidetracking back into the main subject of what this call is going to be about, the REITs. There's a bit in what you're saying is that they're basing the dividend yield on trying to seem competitive against government bonds rather than what the actual yield of the bond is. That was one of the most insane parts of it for me.
Right. I mean, people were thirsty for yield for a long time. Any yield, now, yes, you can get 5%, but, people, their need for yield just expands out, and people just are always getting, pushed further out on the risk curve due to inflation and due to policies. It's a terrible thing. But yeah, I mean, there's some impact to that. That we're seeing a lot of yield max products that are now trying to sell call options to try to get further out on the yield curve and bring in more yield. Obviously money markets become a lot more, feasible or better, better product to sell in this type of environment. And there's some shifts away from, other funds that were kind of mild, had low to mild yields that were acceptable in a zero interest rate environment. But at the end of the day, it's still, you're still investing in things that you think are going to, provide a positive real return in excess of inflation, in excess of cost of capital. And that's, what we're trying to do is what, everyone's trying to do.
The big bag REIT post, is that still going on? Is it still bad for what the banks are doing? Has it gotten worse, or has it gotten better since you've posted that?
The issues that we identified, and over a year ago, we wrote this post. We've been looking into this for almost 2 years now, and it's amazing how little movement there's been really on any side. I mean, the big movement here was when rates first started to rise and public real estate started trading down to pretty significant levels and took a pretty big hit. And then the private REITs that are not mark to market, that set their own values through appraisal-based NAVs, didn't budge. And it's like magic. It's like, wow, the same building in one vehicle, one financial wrapper versus another financial wrapper, this same exact building has such a drastically different valuation. It defies the laws of logic. And of course it does. It's incredible how little has happened in this regard, how little demand for transparency there's been from the investors in this fund, from the regulators, from anybody else. The idea that, hey, we're just going to kick the can down the road until rates drop and until there's some sort of, rebound in pricing from real estate. That doesn't really help the investors in this fund because they've still borrowed those future returns, right? So let me kind of set that up a little bit. There has historically been divergences and convergences between public and private real estate. And over time, you can look at it, they converge, they diverge, they converge, they diverge. There's never been a divergence this big, not even close, but there have been pretty big divergences. Ultimately, they do converge, which stands to reason. Like I said, it's the same building, right? So if I buy a building on day one and I sell a building on day two, in both scenarios, I'm going to buy it at the lowest price I can based on what the seller is willing to accept. And I'm going to sell it at the highest price I can based on what the buyer is willing to buy. And it doesn't matter what the product vehicle is. Now, in between, I might have a different volatility measure, right? Based on whether I do mark to market every day, or if I just, look at it more periodically, I'll have a smoother return. But at the end of the day, day one and day two are going to look the same, right? So here you have these divergences, and then of course they're going to converge again. They're the same asset. It's going to converge. It's going to converge. We've had this divergence and there's no convergence, right? There's still no convergence. So if you say that there's two ways that we can converge, either private real estate crashes or public real estate comes back up to where private real estate is. Well, in that scenario, which is the best case scenario for all investors in real estate, in that scenario, public real estate comes back up and meets private real estate where it is today. If you're a private real estate owner today, you're still losing because you're not getting that future. You've already borrowed from that future return that you would otherwise get if you redeem now and put the money into public REITs. You've got that upward slope still to come. So people are giving up on that. They're giving away that future return stream. And I'm not exactly certain that they're aware that they're doing that. Correct. Yes.
Only one of them can we actually see the pricing on, because only one of them is actually being allowed to be sold.
There are deals done in the private market, and there's some deals. And in fact, we're probably going to talk about 𝗥𝗲𝗪𝗛𝗧 and the 𝗡 fund. In this fund, they've sold properties at very good valuations. Now, of course, they've kind of cherry picked what they're willing to sell based on getting those valuations. The thing that you need to know is that public real estate, when we talk about a publicly listed REIT, let's say, the valuation is being, there is mark to market every day, but the price is a price that somebody's willing to buy it with real money. They're actually bidding in real time on these assets. So it's a real number. You can feel very confident that there's liquidity at that number. That's a real number. The private stuff is using appraisal-based NAV, which is appraised by humans that have natural, human biases that we all do towards what they've previously reported.
Right.
So if I tell you, if I'm a professional appraiser and I tell you this piece of art is worth $1,000, and you come to me 3 months later, I'm very inclined to keep it close to that $1,000. I don't want to sound like a fool and say, hey, guess what? Now it's worth 600. And that's essentially what we're seeing. It's not necessarily that they're trying to lie or they can find some comps that they can kind of point to. They could say, all right, our future real interest rate expectations are lower than they are today, and based on this and that. But those aren't numbers that somebody's willing to buy. They don't have liquidity at that number.
To use an analogy of like what's going on in my own area, I've got family and friends and stuff like that. Everyone's got a mortgage, and people talk about what houses are worth in my area. Most people, because they bought at certain prices, or because they know what prices were selling for during the pandemic, are when they put them up for those prices now, and rates are at 5%. They are having to put their houses on the market for much, much longer. And if they actually wanted to sell their house right now, they would have to lower the price in order to actually get someone to buy it.
Exactly.
And so private and public real estate in this context, publicly traded real estate on an exchange, right, is public real estate. What is private real estate on this bigger scale?
It could mean a few different things. So it could mean that you personally want to go and you want to buy a warehouse or a data center or a hospital. Even some of those are. I mean, what a REIT? When I talk about REITs, right? REIT is not necessarily real estate. It's real estate-ish. It's really a tax treatment. So there's some REIT assets that look more like real estate than others. Private real estate is anything that's not on the public market, anything that's not a listed REIT. What we're talking about here are private REIT funds or non-traded REIT funds. They're also called NAV REITs. They have all these different nomenclatures and names, but essentially we're talking about private equity real estate that's being marketed through the retail channels in the US to investors. And these funds are massive. I mean, this 𝗥𝗲𝗪𝗛𝗧𝗔 REIT fund, over $70 billion. It owns over $110 billion of real estate. There's a Starwood, which is currently gated. There's a KKR. There's a whole number of these. The whole category is over $200 billion in assets. So you have this massive pool of capital, mostly been, marketed towards retirees and low risk investors. Like we said, getting back to the yield thing, this was a source of yield for a long time. It's I think, again, if you look historically at the standard deviation, right? If we measure risk by standard deviation, we look, these things have really been almost a linear line straight up and to the right? There's been very little volatility because, again, there's no mark to market, right? So they're appraising their own values, slow and steady up. This category of fund is massive, and we think it's being valued significantly higher than it's actually worth.
Right. And the ultimate consequence of this, this could continue going, right? Where the publicly traded stuff stays. I mean, what's kind of happening, looking at the charts, is that the public stuff is just sort of leveling off for a bit, which makes sense in the environment that we've just gone from to what we're now in. And then there's the tiniest bit of subjectivity in the NAV pricing, and that tiny bit of subjectivity is leading to this disparity. The human bias is in there, so that's what's happening. What's going to happen that brings these two things together, essentially? Like, do you just not know, or do you have an inkling as to what will actually bring these two things together?
Right. So price divergence, and ultimately what that means is that the public market guys get this great return. The private market guys don't, but they've, if they've been in the funds already, they've already kind of borrowed ahead on those returns. But everyone kind of gets to a point where we can all move forward and everyone's happy. The worst case scenario is there's a liquidity death spiral. And what that means is, there's increasing pressure to sell. There are more redemption requests out of these funds. And, these funds can gate. Some of them are gated now. Some of them were gated. They might gate again. When they gate the funds, they still have to, per their prospectus and the rules, they still have to make 5% liquidity per quarter, which is a lot of liquidity, right? I mean, if they own $110 billion of real estate, over $20 billion, over 20, 20 billion a year in liquidity. So anyway, the more redemption requests force the fund managers to have to sell properties. The market is still pretty much frozen. It's very difficult to sell that much value of properties right now. They are going to sell them at a price where they're going to have to lower the NAV. You can't cheat the NAV on a sales price. The cash is the cash, right? But the NAV comes down. It's going to spook investors who are going to make more redemption requests. They're going to have to sell more properties and on and on. And you get into this death spiral type scenario. That is worst case scenario. It's not necessarily something that is going to happen, but it's something that very well could happen.
And so, yeah, so basically if they don't start, what could happen is when the properties start going to sell, there could be a huge gap between where they valued them and the money has to come out to some degree, right? So what you're saying in terms of how they're actually managing to do a dividend that is bigger than the amount of money they're making is people are depositing cash while people are withdrawing cash. Now, it makes sense to use that money to pay off because it's already in cash. But sorry, I think you're on mute.
No, I'm here. Can you hear me?
Oh, yeah, cool. But they're using more and more of basically this money that's coming in to pay for the money that's being withdrawn.
Yeah, they can't cover their dividends with cash flow. Right, with cash being generated by the fund, which is always a red flag. That's like the first thing. If you're worried about any investment, if they are paying a dividend that they cannot cover with cash flow, run. That means that the dividend is being generated out of some sort of financial engineering or some sort of pass the buck game. What's happening here, they are on record. Blackstone is on record pointing to the performance of the fund as a reason why they think they can bring in more capital to satisfy the redemptions. Again, people investing into the fund, not that they're going to use that money to buy more real estate, but to satisfy redemptions, right? Money coming in from one to pay off the other. And they've said that the performance of the fund is the reason why they think people are going to put more money in. In other words, if they mark the NAVs down, that goes away. And then how are they going to get the money in to pay people out? They're going to have to sell properties, which means they're going to have to take a massive drawdown. The dividends that are being paid as dilutive shares. So first of all, if you're getting shares as your dividend, you're getting them at the current NAV. If the NAV is overvalued by 25%, guess what? Your dividends are 25% less than you thought they were, right? That's right off the bat. But the way they're accounting for it and the way they're generating these extra shares to pay out for dividends, it's not coming from cash flow. So, I would be very worried about that.
That's just terrifying, right? Because basically the new money coming in should be buying more real estate. And it shouldn't, that's what people are expecting. It's also funny, given this conversation that we've been having with regard to, this is always my frustration with regulation, when they're regulating things like ETFs, which they don't know that there's issues yet. They're just scared of the unknown. This is a foreseeable issue of the old system. This is a broken old system. They're trying to regulate the new system. These are old investment vehicles, right? I mean, unless I've gotten this wrong.
All sorts of scandals and problems with private REIT funds. When these funds came out, they were advertised, hey, we've solved those issues. Whether they have or not is to be determined. I mean, you would think that the regulators would be looking at this. I don't know. Nobody's called me. Nobody's asked me about it. In fact,
the opposite, right? You've had lawsuits.
I haven't had lawsuits. We have had FINRA tell us outright that we can't bring up this fund in the context of another fund that we were offering, which now I can't say.
Right. How come you can say that now?
They referenced an obscure rule that they have, something about comparison one to the other. I mean, the whole point of what we're doing and exposing this thing was to show people, to help people that what they're in now is drastically overvalued and here are the risks. Felt a moral obligation to say it, but no, the regulators wanted us not to talk about it. Or at least FINRA, they wanted us not to say anything about it, and certainly not to say anything in the context of our fund, which we thought was better for investors for very specific. I mean, we weren't just saying, "Oh no, we're better than them." We were showing the cap rates, the different valuation methods that we use, normalizing apples to apples for geography.
And this is their own published information, right? You're just interpreting the information they publish. You haven't.
We referenced their 10Qs quite a bit. We did our own models, and we showed our work. And I've shared it with people at Blackstone who've requested it, or at least telling me that they're sharing it with Blackstone. And so we're not trying to hide anything. We're not going. We're trying to be transparent here, right? If we've done something wrong, show me what's wrong, and we'll correct it, right? We have no incentive here to try to take anyone down. We're trying to we're trying to show investors that, hey, you guys are headed for a pretty bad event here, and you should be aware of it. And nobody else there's no money in that message, right? So nobody else tries to share that message. Nobody wants to hear it. I've had a financial advisor say to me, call me up with questions about our paper, said, whatever you do, the first thing he says, whatever you do, don't send me an email. Don't send me anything but email. Don't send me the paper. I don't want to see it. I don't want to know it. I don't want it in my inbox, which, tells you the state of things right now.
Yeah. What bugs me is, I guess it's a tactic. I think it's a tactic that I don't think anyone particularly set this up, but there's a lot of confusing words here for something that is arguably quite simple, which is the simplest word for this is theft. It's not quite someone breaking your window and taking your TV, but these people are giving them money for their retirement, thinking they're buying real estate, and actually what they're doing is giving that money goes straight to the bank and then to other people who think they're getting income from the property they bought. And so what they've done is, and the hope is, so you're giving it to the bank and they're just giving it to another person and taking commission on the interim. And of course, the larger the fund, the bigger that commission is. And 70 billion is huge.
Yes, I'm not sure I put it exactly that way, and I'm very careful. What I say. I mean, we're just trying to do here a cold analysis. This whole thing started just in a very purist. We were doing a competitive analysis. We're breaking into the real estate fund space. We want to understand what other people are doing that's working, right? Out of a with a lot of respect for what people have accomplished that's done well. I said, all right, let's really try to understand this. How does this fund work? Why has it been so successful? Why have the returns been so unbelievable? I mean, overcoming a fee hurdle, the fee difference is, this is an expensive fund. And then having alpha on top of that is almost unheard of. So what are they doing so well? What are they, everyone says, oh, they're so smart. Okay, let's try to understand it, right? And then we got, we came to find all these red flags. We didn't try to find the red flag, we were just trying to understand what they're doing. And it's very disappointing when, you see that so much of the ecosystem from media, regulators, clients, so many people really aren't interested. They really don't want to know. They're not truth seekers. They're the default opinion is, well, they're big, so they're probably right, and you're small, so you're probably wrong. And it's not a debate on the merits of the argument. It's a debate on the the reputation of the person conveying those arguments. And it's very disappointing.
I get lost for words on it. It's just that sort of ideology of like they're big, so they're probably right, but they're big, but they also whenever someone has an incentive to lie, there's a high chance that they will. Lie is a big word for what they're doing. It's similar to a lie of omission, sort of thing.
There have been clear efforts to obfuscate, right? I've seen some materials coming out from related to this issue where they've kind of pointed to this, said, oh no, you're wrong or this or that. And they, in that effort to defend some of the accounting practices here, they've been very clearly obfuscating, if not manipulating the facts. But when you have a big war chest and legal fund, you can get away with that in today's day and age. I mean, you would think after 𝗪𝗪𝗪𝗪, right? So Mark 𝗪𝗪𝗪𝗪 comes out during the whole, when Madoff was at his peak, and wrote a white paper literally proving that Madoff was a fraud. And he sent it to the regulators, and he sent it to clients, and he sent it around. And absolutely nobody gave it a moment's notice. Nobody cared what he had to say. Everyone just assumed he was wrong. So, Madoff was a big name, managing a lot of money, had some sophisticated investors. Nobody gave it any air. and it's amazing to look back now. And I would encourage anyone watching, read the 𝗲𝗏𝗪𝗛𝗧 paper, because read it now, today, knowing that Madoff is a fraud. And it's like, how is it possible that this didn't, that this wasn't a 4-alarm fire, and set things in motion? Like, how is it possible that this was ignored? Because the paper was ironclad, but it was ignored. It was ignored, and I don't think anybody's learned any lesson from it.
It's interesting. It makes me think of that scene in The Big Short with Michael Burry's character, and the way he's like, well, he thinks this happens because people want authority figures to exist. And so they choose authority figures, and how they choose authority figures is what's familiar. What's a familiar thing of what encapsulates an authority figure for me. And so what could appear more familiar than, say, BlackRock or Bernie Madoff, who is managing tons of clients and stuff like that. And you want authority figures to exist, right? Because the world is so complicated. You can't be the authority figure on everything. You need experts. And then I think what's happening, like, the thing is, I think it would be beneficial for BlackRock to have someone put them in line. I think if I was working at BlackRock, or it's BlackRock, right? That is one of the biggest funds. Oh, Blackstone, sorry. Cheers. Just correct me when I say it, because I am basically, I am a retail investor, so it's easy for me to get these things wrong. But I can see how someone in that fund would feel it is their duty to prop up the fund, to make sure that, because if the fund, as you said, the liquidity death spiral can happen if it drops by 10% too quickly. And so suddenly you've got a motivation. In some ways, it's honorable to find information that will help keep the fund up, and then hope that the price of real estate catches up with it.
Yes. Yeah. The greater good.
Yeah. And the scary thing is, through pure chance, I think that has happened for, say, 20 years, because interest rates have always gotten lower.
You have since the global financial crisis, there have been opportunities to get bailed out by the market, by betting on, eventually number go up, or, rates down, or the Fed put, or however you want to put it. But, at the end of the day, the institutions, the people that are bigger than the markets, aren't a lot of them, but there are some. The Federal Reserve Bank is certainly one, has been on the side of, bailing out, not savers, but investors in one form or another. And again, that is considered the greater good. There's no, there used to be a real feeling of, honesty in the markets, or, the value, a company is worth something, right? The valuation, the real true valuation that you come to, that's the truth. And a short seller was a good guy, because a short seller was a truth teller, right? They can't abide the fact that a company is overvalued. And if you're a value investor and you see that a company is undervalued, it's wrong. It shouldn't be that way, right? You do the research, you say, oh no, look at this accounting trick and this and that, and if you true it up, then this stock should be 20% higher, and you put out a thesis and the market would react to it. We've moved to a market based on narratives now. And if you have a good story to tell, and if you have a good narrative, NVIDIA is a good example, there is no ceiling on what it's worth as long as the narrative is good. It doesn't matter. The AI narrative is great. It is great. Truly, it is great. NVIDIA is a great company. There is no value at which NVIDIA is overpriced as long as that narrative is great, right? Yeah. It doesn't matter what their revenues are, what their future expected revenues as a result of AR. It doesn't really matter. Right? There's no tether to reality. It's just narratives, right? What is the narrative? It's the same with, the stock market as a whole. And, I think the regulators and the Fed and the people that are in a position to kind of manage or police things a little bit to some degrees in certain pockets have bought into that idea of the greater good as up is good. Up is good. Things becoming more expensive, price higher is always good. Down is bad. If you're a short seller, you're a bad guy. If you're saying that, if you're bearish and you're saying that things are overvalued, you're a bad guy. You're not a truth teller. You're on the wrong moral side. Their job is to influence the markets so that number always go up. That's the state of things.
Do you have any skin in the game on this bet against net asset values being overpriced?
Not directly, no. I mean, I have a company, and we are in this space. We're managing real estate assets, public market real estate assets for investors.
Mm.
We're doing it because we think it's not we didn't come to this conclusion because we're doing it. We came to that because we came to this conclusion, right? This is how we would invest ourselves and how we see. I don't have any bet against Blackstone. I wouldn't recommend it. I think BREIT is depending on performance and carry fees, but you're basically looking at in a best case scenario about 15% of revenues for Blackstone, which is material. But if rates were to fall, that would be a much bigger deal. I mean, you really have to hedge out your rate exposure if you were going to make that bet. It's a complex bet. I wouldn't recommend people do it. And I wouldn't bet against their ability to find new capital or to kick the can down the road either. So I'm not sure that that's the right play here. What I would say is that if you are in a private REIT fund that you come to see is overvalued, now run your own valuation metrics yourself to see if it's overvalued. And if so, find assets that are not overvalued, right? And we like public real estate, but there's plenty of other things to invest in. And then go back into the private REIT fund when you think the valuations are fair.
Do you think the situation could get worse then if interest rates go up? I mean, it's pointless, I think, to speculate on what he's going to do, but you can go, what would happen if interest rates went to 6%?
I do think things would get worse if rates go up. I do think rates going up is a non-zero possibility. I think, the fact that inflation has leveled off, inflation hasn't come down, it's just leveled off. I think we're still at risk of higher inflation. And I think there's really no guarantee. People are acting like there's a guarantee that rates are going to come down before they ever go up again. And I don't think that's a guarantee at all. I think people should be prepared for all scenarios. In a rising rate environment, if we continue to have a rising rate environment, not all real estate subsectors are going to react the same. So, again, back to what I was saying earlier in the conversation, these REIT funds, they include everything from, cell towers and hospitals, data centers, to actual real estate. Office buildings are trading on their own issues, right? So I think there's going to continue to be a dislocation between the different real estate subsectors. While they've traded for a long time, or at least up until about a year ago, they spent about a decade trading as one monolith. I don't think it's going to continue. I think we're going to see real separation between the different subsectors.
It's interesting. You've done a post on data centers as well. And so there's a similar, conflict of interest or the similar, there's quite a big issue there. As you said in your post, that basically, anyone watching this should go read it on your Substack, and I'll include a link to it. But basically, you talk about how innovations like, you use the example of video, but I'll use the example of iPhone. Chips were used, and it was predicted that chips would get twice as large and twice as cheap every year. And it would be exponential, and it was, which is one of those most remarkable predictions ever. But what also happened was the chips that existed, as a result, got twice as bad every year relative to everything else that came out after it. And we're in a similar, potentially with AI especially, in a new era of chips doubling in affordability and performance every year. And therefore, if you are invested in a REIT for chips, theoretically, the large server that you've just built is about to become exponentially less valuable every year.
That's exactly it. Yeah, I call it Eroom's law. So Moore's law is the law that states that the price and the capability of technology doubles and keeps growing at this exponential rate. So I took Moore backwards, which is Eroom, and the law is that the existing infrastructure and hardware then becomes less valuable. The way these data centers work is there's a tremendous cost up front on CapEx. You build these data centers out, you're financed, and by the way, they're getting financed at increasingly higher rates. And then you sit around trying to recoup the money before the technology becomes obsolete. Well, guess what's happening? And by the way, the pricing pressure and the competition in this space from the likes of AWS and Azure, I mean, it's really difficult for these companies to keep up. Yet people are betting on it as if they're making a bet on AI. You're not. You're making a bet against AI. You're making a bet here that there will not be further innovations and technology breakthroughs on the hardware side. That this old stale technology,
the thing that you're going to spend 10 billion on, is going to be that's currently making 100 million a year or something like that is
Exactly.
going to be making that in 10 years time. Do these funds, so there are funds for, to be honest, until I read that post, I didn't realize that there were ETFs for, is it an ETF, by the way? Am I getting these things confused? A REIT is a form of ETF.
Yes. Oh, no,
Yeah.
REIT's not, a REIT is, just a holding company of real estate.
Do you potentially see the same thing happening there then? That a collapse in these funds as well, or?
Well, I mean, the one thing is, those are mark to market. So, I think, those have been bid up a lot on, just the technology upswing and on the AI narrative. And, they're already starting to come down a bit. But at the end of the day, that's a real bid from a real buyer on the public markets, right? So, it's a little bit different. There's no shenanigans. There's no, accounting tricks. I mean, they're being bid at what the market's willing to pay for them. I think the market is wrong. I think they're overvalued, but hey, maybe I'm wrong. Who knows? I mean, that's why.
How do you go about assessing the value of these things? So, like, is it possible for an everyday person like me to see how much a data center is selling for and stuff like that?
Absolutely, yeah. You can look at their financials. You can dust off your Ben Graham book and treat them like an operating company and take a look. And just the big.
But is it just those standard SEC filings that you're talking about?
Yeah, of course. I mean, but the one big variable that I'm talking about here is depreciation, right? So the depreciation of a data center, I'm saying is at a faster pace and is more, more important than, let's say, a warehouse where they, have a truck that they're, that loses some value. This is like the whole business is depreciating as fast as technology is increasing.
Yeah, I mean, arguably, you'd think that the depreciation of a data center is faster than that of a truck.
Exactly.
Yeah. And yet you pay a higher premium.
As long as we're getting these technology breakthroughs. So again, people are betting on these data centers because they're bullish AI, because they're bullish technology, when in reality, it's a bet, it's a flip side, and it's a bet on the slowing.
Right. That's interesting. And so really, how, if you were in favor of AI and you wanted AI to progress, how in your mind would you invest in it?
So, I mean, that's a big trick, right? So I think, look, NVIDIA is obviously the beast, a great company. The valuation on that, I mean, you're going to pay through the nose for that company. It's not easy. I mean, there's so many startups, so many small companies in the space. Some are going to be incredible companies. Others, who knows? I think the things that are happening online in AI right now are incredible, right? I mean, I did this thing the other day, created a whole song for my mother's birthday, like a whole, lyrics and I mean, it's incredible what you can do. There are going to be some winners and there's going to be a lot of losers and a couple of huge winners. And it's very difficult to say. It's early stage. I mean, it's just like, look, Amazon and Facebook as stocks, they all grew in the aftermath of the dot-com bubble, right? As things collapse, there are going to be some winners. It's going to take a long time to know who's really able to monetize the technology and who the real winners are.
I think actually we've covered the main topics, and if there are any, it would be nice to do a call again at some point if there are any questions on this. Is there anything else that you'd like to talk about before?
No, yeah, I'd love to do another one. And I'm not always bearish. I wrote a Substack.
No, you're a realist.
I'd like to think so. I mean, everyone thinks they are, but I certainly aspire to that. And the numbers really guide our view. What we do the analysis, the numbers are what they are. If we don't like it, we call it like it is, and that's what it is.
Cheers for the great call. Thanks very much, Phil.
All right, take care.
Have a great day. Bye.